In this overview, we'll look at the value composite investing model based on the work of Jim O'Shaughnessy in his book, What Works on Wall Street. The key fundamental investing insight behind this model is this: using a combination of value metrics performs better and removes the risk of relying too heavily on only one measure of value. At a high level, the strategy starts out by filtering out the lowest quality stocks in the market. It then selects the least expensive stocks using a value composite ranking. The source and the evidence behind the strategy, as I mentioned, this is based on Jim O'Shaughnessy's book, What Works on Wall Street, the 4th edition. In O'Shaughnessy's backtest, he showed that the value composite investor model returned 18% from 1964 to 2009 versus 11.2% for the all-stock universe. The investment thesis behind the strategy: using a composite of value factors can both enhance returns and improve risk-adjusted results versus relying on a single factor approach. Okay, let's now take a look at the value composite investor model that we based on the work of Jim O'Shaughnessy and What Works on Wall Street. The first step is to introduce a quality filter. So here what we're doing is we're screening out the junkiest stocks in the market. These are the stocks that have the potential or more potential to be value traps. So what we do to remove these stocks is we screen on things like declining expected future earnings, cash flow that's not keeping up with earnings, high levels of debt, and very low relative strength. Those stocks that score in the bottom 10% based on the combination of these quality metrics are removed from the universe. Next, we then look at all stocks through a series of value factors. So our model looks at price to book, price to sales, price to cash flow, price to earnings, enterprise value to EBITDA, and shareholder yield. All of these value metrics look at different things, whether it's on the balance sheet, income statement, or cash flow statement. From there, stocks are ranked based on the combination of all the value factors above. This allows us to create a composite score for each stock. The top 1 to 2% of stocks are the very best according to the model. The value composite model run on Validea provides investors with a quantitative way to capture the value premium in a relatively concentrated group of stocks using a series of value factors.